चलो क्वेश्चन नंबर 3 नी consider a bond with 3 years to maturity. It has a face value of rupees 1000 and a coupon rate of 8% with annual interest payment, and it is selling at par. Assume that yield of the bond changes to 6%. You are required to answer that. First, whether the price of the bond will increase or decrease. That is the question. Friends, over here, the question says like this, that whether the price of the bond will increase or decrease, that is the question. We already have understood something like this. It is 3D question. Answer of question number 3D. Friends, over here the question says that, say, you are required to determine that whether the price of the security will increase or the price of the security will decline. That is what we are required to answer. Now this depends upon what is the change in the cost of capital. Whether the cost of capital has increased or decreased. Because if at all the cost of capital has fallen down, then the price will definitely go up. And if at all the discounting rate has gone up, then the price of the security will fall down. So depending upon the change in the required rate of return, price of the security will have a reflection. Price of the security is going to reflect the change in the required rate of return. If required rate of return is fallen down, then the price will go up and vice versa. This is what we understand. Now the question only says that the required rate of return has changed to 6%. So what it was earlier, that we are required to find. What was the required rate of return? What was the yield to the investor earlier, that we are required to find. If at all, suppose if at all it was 4%, then from 4% to 6%, then the price will fall. And if at all earlier it was, let us say 10%, then 10% to 6%, the price will go up. That is what we understand. This is the logic. Now as far as this question is concerned, the question says like this. A bond having 3 years to maturity. So the time period is provided as 3 years. It has a face value of rupees 1000 and coupon rate is 8%. Face value is rupees 1000. Rate of interest is 8%. With annual interest payment, that's fine. And it is selling at par. So P0 is rupees 1000. Assume the yield on the bond changes to 6%. Now dear students, in order to compute that, say what is the rate at which it is giving the return right now, we need to have the information about the redemption value of the security. We can see that, say, the redemption value of the security is not provided to us in the question expressly. So we will assume that, say, the redemption value of the security is equal to the face value, that is 1000. So if at all the redemption value is equal to the face value, current market price of the security is equal to the face value, then return to the investor will be equal to the rate of interest. It means that, say, right now the return to the investor must be 8%. So from 8 it reduces to 6. So in that case the price of the security will go up. That is what we understand. This is the way we are required to give the answer for the first question. I am dictating answer to you and then I am taking any doubt if at all anybody has. Write an answer for the first question. In that, write down first point. Over here, we have to determine that whether price of security has increased or reduced. Full stop. Second point, in order to draw such conclusion, comma, we need to find current yield to investor. Full stop. Third point, in absence of any information about redemption value of security, comma, we assume that it is face value of security. Full stop. Fourth point, redemption value, comma, face value and current price of security are same. Full stop. In that case, return to investor equals to rate of interest, that is 8%. Return to investor reduces from 8% to 6%, comma, so price of security will increase. Full stop. That is the way we are required to write the answer. Second part of the question, what percentage of this increase or decrease, means what percentage of this increase, okay, now we have understood, comes from change in the present value of the bond's principal amount, and what percentage of this increase comes from change in the present value of the bond's interest payment. That is a question.